Okay, good afternoon, everyone. Thank you for joining in. We are a few minutes late, but that has allowed a full house of 180 attendees to trickle in. So thank you for those who signed in early for your patience. Without much ado, let me introduce the speaker for our third Faculty Insight series. We are very lucky to have Rob Engle, who's a professor of finance at the Stern School of Business and the 2003 Nobel laureate in economics. Rob, in my view, at least many of us in the department consider him to be the father of financial econometrics, most importantly with his models of volatility, stock returns, correlations across different markets, and virtually anything that's traded. If you want to understand how its prices behave, Rob always has a new insight and an angle on it compared to anyone else I've met. A genius is someone who is good at more than one thing. Rob is good at least three things I know of. Besides econometrics, Rob is a world champion ice skater, which some of you might not know. But third, and the most important, he's a great citizen of the school. He first set up the Volatility Institute, which provides daily online updates on volatility, correlations, and other properties of financial markets. Now he's co-heading a version of this institute that's Volatility and Risk Institute, along with Dick Perner. And the Institute is working on really interesting themes such as geopolitical risk, climate change risk, cyber risk, and other risks that we are likely to face in the near future. One of Rob's views of markets that I like a lot is that there is risk, that the risk will change. And I think Rob is going to tell us a lot about that today, especially what we have seen in the last month or two. Over to you, Rob.
Thanks, Viral. It's great to be here, and we're all trying to figure out what's going on in this world around us, and it's exciting to talk about it. I'm going to show you some things that we see on the VLab website, which is a great resource, and then a little bit on sort of my speculation as to what it means. Let me share my screen and pull up some slides, which I'm going to use. So this picture is actually a family vacation going into the Maine woods, and it's sort of my view of the ultimate social distancing. We're talking about social distancing now. We might be talking about it forever, maybe. I don't know what is going on. But anyway, so this seemed like a nice theme for our discussion this morning. I'd like to start by asking sort of a very prosaic question. How does this COVID-19 crisis compare with the global financial crisis? I mean, we've all just been through that, and obviously there are a lot of things that we'd like to know about it. But the first thing is that obviously they're completely different causes. One's medical and one is financial. And so optimal policies would have to be very different between these two. But both of these have major spillovers to the real economy, and that's kind of what we're seeing. And the stock market responds by looking at the price, the values of firms, all the firms in the US, for example, or in the world. And so if these spillovers to the real economy are being measured by the stock market, then we might expect to see a lot of similarities in the stock market. Furthermore, there is some inefficiency that's associated with a big downturn or a crisis like this. In the global financial crisis, we think that capital was actually wasted by too much building of housing and other things that were priced as bubbles. And this is kind of a cost that we had to spend some amount of time overcoming. there doesn't seem to be that sort of capital expenditure in this crisis, but it's more like human capital. Labor is being destroyed, and it's human capital is being destroyed by the shutting of firms and laying off of workers and so forth. So both of these will take time and investment to recover. You mentioned climate change, and I just want to make a comment here because I'm very interested in climate change, and a lot of people are asking, what's the impact of this pandemic on climate change? And it seems to me once this pandemic is over, we're still going to be faced with a transition to the low carbon economy. So the climate problem is still going to be here, and we're losing time working on it. But maybe we're practicing too. We're learning how the social distancing is a way of reducing our transportation. It's a way of reducing our industrial emissions. And maybe we'll learn a little bit about how to be more sustainable. What we see, one of the key things we're seeing is the drop in oil prices but that's partly because of declining demand, as I just described, but it's also because of increasing supply through the competition between Saudi Arabia and Russia, and actually with the U.S. So the net effect of this is that the cost advantage of renewables is shrinking and may reduce some of our investment in renewables. But another side of it is that we're going to see a lot of fossil fuel sector bankruptcies. And from at least a climate point of view, that's a transition that probably needs to happen. In the big bailout bill, the COVID-3, there's lots of money for companies that are being impacted by this. And many of these are in the fossil fuel energy areas. So I think bailing these companies out is actually a missed opportunity to invest in climate change. And finally, we notice that this pandemic is caused by what people call a zoonotic virus. That is a virus that comes from animals jumping to people. With global warming, there is a view that I've heard several scientists say that we're going to be interacting with other kinds of animals from what we usually see, because animals are going to be migrating northward. And so there are reasons to suspect there may be other pandemics, and wonder, is this just a dress rehearsal for the kinds of things that will happen when climate change is upon us? Okay, so let's turn to looking at some of the details of what we see when we look at the pandemic. I like to show the map of the world that is on the opening page of VLab. VLab is this website, and this is its address up here, which is sponsored by the Volatility and Risk Institute, and it's updated every day, and it plots volatility forecasts for each country and color codes them, green if it's low and red if it's high. And this is what we saw at the end of January. This is what I showed my class the last day of winter quarter. It turns out just a month later, it became a lot more red. And then today, it's a lot more red. So we're seeing high volatility almost everywhere in the world. And this is about the only exceptions are a few places in Africa and Mongolia and so forth. China actually is not as red as all the rest of the world, but we're seeing an extremely high volatility period. One of the additions to the VLab website is superimposing on this the cases of coronavirus. And these are the circles which are shown on this map. And if you go to the website here, which is going to be linked to VLab, but at the moment you just have to know to put a /COVID-19 here, and it will take you to this website. And you can go through dates and see what this looks like. And on the next slide, I'm going to show a very fast movie of what it looks like. If this is starting January 22nd, oops, and as you can see, over time, the cases grow and the colors turn red. So there is some relationship between cases and let me do that again so you can really see that. So I encourage you to do that, because you can do that for different parts of the world and really get sort of a picture of how the infection has grown and how the volatility goes up. So what we and this gets updated every day. You can see this is going through April 6th, which is yesterday. So I'm going to talk a little more about what this relationship really looks like shortly. So let's just look at a couple of pieces of information about the volatility. Here's the Standard & Poor's 500. It has a volatility which is typically low, between 15 and 20%, but here on VLab it's jumped up to more than 100% in the middle of March. It's since come down. It's now about 65%, and that was on the weekend. Yet today it's about 63 or something like that. The implied volatility is a little bit lower. This is the VIX in blue, and these are both ways of measuring volatility. You can see it corresponds to a dramatic decline in the price of the S&P on my the green curve at the bottom here. Well, one of the things to notice here is that the VIX is actually below the GARCH, where in fact normally the VIX is above the GARCH. And an explanation for that is partly that it's possible that the VIX has more information in it than the GARCH does, because this is a forward-looking measure by traders who are paying attention to what's going on. And it may be that they foresaw some of this bailout bill that's been this giant $2.2 trillion bailout bill, Corona 3, that was signed at the end of the month. And so that might be why it's a little bit lower. It might also be that that traders haven't got a good view as to what's going on, or that the GARCH model is not very good at these kinds of extremes. All these things are possible. So if you look at this graph, it shows the volatility not just over the last 2 years, which is what I just showed you, but over the last, 80 or 90 years, something like that, going back to the 30s. And you see we have a peak today, which is over 100%, which I just showed you, which is actually higher than we had during the great financial crisis. So the volatility today of the S&P is really above what it was in the financial crisis. It's comparable to the highest day during the 30s, which was in 1929. In November 1929, volatility hit 117% using the same model through the whole sample period. So we're seeing something which is comparable to the Great Depression. The other event which is dramatic on here, of course, is the October '87 crash, which was higher than any of these points in terms of the volatility, but it was also very short-lived. And we don't know, of course, yet whether this is going to be short-lived or not. It's one of the questions we're trying to answer. If you look at quarterly, or at least 66-day returns, you can see that there are a lot of negatives. That the negative down here is that in the first quarter, the S&P has lost about 30%. During the financial crisis, it lost more than that. It was more than 40%. And during the Great Depression, it was more than that. So the decline has not been as great as what we saw in the financial crisis. And if you look at the drawdown from the peak, you'll see that the drawdown in the financial crisis was about 55% from peak to trough. In the internet bubble, it was about 45 or 48% or something like that. And thus far today, the drawdown has only been something like in the low 30s, 33%. So if we're going to get something which is as severe as the great financial crisis, we've got a ways to go. We don't know whether we've seen the bottom yet. The market yesterday seemed pretty optimistic. I don't know whether we've seen the bottom or not. That's obviously a question that we'd all love to know the answer to. So how bad can it get? Well, once you have a volatility model, you have a model which tells you how fast the volatility can change. So if you think that what's going to happen over time is that you will get a string of bad news so that the volatility can change, a volatility model can tell you how bad can it get. So for example, if we take this model with the high volatility we see today and simulate it out for a year, thousands of times using actual bootstrap residuals from the data, and sometimes it will have a whole series of bad events. See, what are the quantiles of that distribution? This is like the way you calculate value at risk, but it's calculating value at risk a month or a year in the future. And this incorporates the skewness and the kurtosis of the volatility models and the mean reversion of the volatility models. And we do this every day on VLab, and you can see this sort of thing. It says that today there's a 1% chance that in a month the stock market will be down by another 50%. There is a 1% chance that in a year it'll be down maybe another 80%. This doesn't say, this is not a prediction, this is a 1% chance. One time in 100 it would be that bad. So this gives you a way of thinking about what are the worst case scenarios from this kind of a model. Okay, let's just look at a couple other assets. Crude oil volatility has risen up to 160%. That's even more volatile than the S&P. And it's come down a little bit here. It's now like 130, but it's very high. If you look across assets, across countries, you see high volatility in many different countries. The US is sort of in the middle of this list of high volatility places. Brazil is the worst. If you look at sectors, you see energy has the highest volatility, followed by financials. If you look at exchange rates, the Russian ruble is the most volatile, going down Mexico, Norway, the Rand, Colombia. And if you look at commodities, you see an interesting picture. The highest volatility commodity is unleaded gasoline, and this has a volatility well over 100%. Crude oil is high. Crude, petroleum, Brent crude, palladium, energy and metals, heating oil. These are almost all the oil sector. So we're seeing a very high volatility throughout this range of commodities. Finally, what about treasuries? We have a flight to quality that is what we expect, so that you see actually the prices of 10-year treasuries have risen since the pandemic broke out, and the volatility has gone up. The volatility is now as high as 16%, which is high for a bond. It's low for a stock, but it's high for a bond. And we think that there is some possibility that with this high volatility, bonds will have a change in value, which is fairly substantial. You see here, they could go down by as much as 7% over the next month, or maybe 10% over the year. Well, that's not so much. So that's one reason why bonds look like a safe haven. They're not so volatile, and they don't move so much. They don't have such long tails. How about correlations? Correlations have risen between commodities. This is the average correlation among all pairs of commodities, and this is a little picture which shows what the correlation structure looks like today. But these things have risen. If you look at equity sectors, these are the different sectors of the global economy, or I guess the U.S. economy. You can see that correlation is much higher than it is between commodities, but it has also risen dramatically over the last couple of weeks. If you look at international equities, their correlations have also risen. So what we're seeing is that all these asset classes tend to be moving together. But here's one that's not, and this is worth thinking about. This is exchange rates. Exchange rate average correlations have gone down. They're actually fairly low, but they've gone down. And what that means is that not all these countries are moving in the same direction. But of course, remember that an exchange rate is a relative price. So we're asking whether they're all moving in the same direction relative to the dollar. And the answer is no, they're not. They're moving in different directions. There are some winners and some losers, and this shows up in their exchange rates. We might be worried about systemic risk. We have a lot of measures of systemic risk, and these are based on something we call S-risk, which is the amount of capital a financial firm would need to raise in order to continue doing business if there's a 40% drop in the global equity market over the next 6 months. A lot of people think of this as what it would cost to bail out the financial sector if we have a big drop in equities. Well, we haven't had a 40% drop yet, but we're some substantial way there, and S-risk is the question of what would it cost if we had a 40% drop from here. And if you look at, this is a plot of the world, what you see is there were peaks during the financial crisis, the European sovereign debt crisis, a peak which I think had to do with China's slowdown, and now we get this other peak right up here. You see this thing shooting up in the air here? It says we're now up to about 5 trillion it would take to bail out everything. Now that actually China has a big piece of that. And so if you look at the same picture without China, you see the same peak up here, but it's only $4 trillion because actually China has an S-risk of about $1 trillion itself. And as a state-owned sector, it might be that that's not going to end up needing to be bailed out. So where does this peak come from? Well, part of it's in the US, and you can see here in the US, we've got this very strong rise in the last couple of weeks. The background is what we think the capacity is of the US, how much S-risk we can take without it turning into a crisis, and we're actually just crossing this threshold today, which is worrying. If you look at Europe, you can see it's not as big an increase, and that might be good news. But maybe not either. Why not? Well, if you look at European banks, the highest is BNP Paribas, then Crédit Agricole, Société Générale, HSBC. One of the things about these banks is they have incredible leverage. Look at the last column here. This is the ratio of debt to equity of these banks. This is accounting debt to the market value of equity. This is over 100 for Crédit Agricole, which means that it's got 100 times more debt than the value of its equity. That tells you that a tiny variation in the fluctuation in the assets of this company could bring it to bankruptcy. This is a result of stock market values falling dramatically and to very close to zero. And the reason this these banks are not bankrupt is because there is a very strong presumption that the government would step in and rescue them if necessary. And when Lehman failed, it had a leverage ratio of about 50 to 1. And so when you see banks with a ratio of 100 to 1, it suggests that they're highly risky and must have implicit guarantees from the government. Consequently, the increase in S risk is minimal due to this financial crisis. They were already pretty much maxed out. In the US, you see the leverage, this doesn't show leverage, but leverage is much lower. But what's dramatic is what's happened over the last quarter. Since 12/31 till the 3rd of April, S risk went up for Citigroup by $40 billion, for Wells Fargo by $67 billion, for Bank of America by $73 billion, JP Morgan went up by $84 billion. So these are enormous numbers, and they're primarily due to the fall in the market cap of these companies. So this dramatic increase in the S risk is a result of falling values for these companies. Why is that? Well, probably because their assets are falling in value. Some of these due to the oil price shock, because they have a lot of paper from fracking and other kinds of fossil fuel energies, but also just from their loans to the general real economy. So what explains all this volatility? Well, it's the virus. And I'm going to show you some results which are very preliminary. And I really want to appreciate Sila Allen and Ahmet Karagözlü, who have done lots to help with this analysis. If you look at the logarithm of the cases of COVID-19 for 8 countries, you see a sort of a nice, interesting picture. You see a sort of a linear section here, which is the exponential growth part. You see some curvature in some of these countries, particularly Korea and now Italy, which suggests they're reaching a peak, and China, which has been concave for quite a while. So it looks like there's sort of 3 regimes. There's kind of a slow growth period at the beginning, then it accelerates, and then it gets a cap on the top. So if you think about trying to build a model, you might be interested in trying to identify these regimes and figure out what variables would be useful for predicting them. Well, it looked easier with 8 countries than it does when you look at a bunch more. And we've got 80 countries that we're following on VLab and for which there are case data. And so the problem is, when do you switch from one regime to another? What observables do agents see that help them forecast where this is really going to go? And I think we hear nightly from the governor about whether this thing is starting to taper off or not. How much curvature is there in this in these curves? So here's the dependent variable. This is the change in volatility from January for each of these 7 countries, and you can see it really went up for all of them, but not the same amount. And if you look at a plot of the log of cases against devol, you see it is more or less positively sloped. The more cases there are, the more volatility has gone up across countries. And if you look at the returns, you see all these markets have shown dramatic falls in the stock market prices, although there is definitely some recovery showing up here starting something like last week. And if you plot, again, against cases against the returns, you see more or less a negative picture here. So what this preliminary model is going to do is going to calculate the logarithm of the confirmed cases, the logarithm of the the infection rate, which is the rate of growth of the number of cases, the log of cases, and we use a lag of 14 days because that's more or less what the quarantine period is for COVID. And we're going to use a curvature variable, which is the cases at time t, the cases 14 days ago, minus twice the cases halfway in between. So that might pick up when it changes from being convex to concave. We're going to regress those on the dvol and put in time fixed effects and some spillovers. So here's a model to look at, which is the dependent variable is the volatility. Here we see log cases is quite significant. The infection rate is significant, and the curvature is significant. So all three of these variables are significant. We get a little bit from the US infection rate, which says that is also significant. There are no time dummies in this model. If you put in the global effect, it doesn't work as well. It's and you get what might appear to be the wrong sign on the global infection rate. Or you could just put in time dummies and just deal with the cases, in which case the case variable is the most significant one. If you do the same thing for returns, you see something sort of similar. The log of cases is the most important variable, and the USA infection rate is also important. If you try to put more variables in, most of the things that we've tried, like population and other things, don't seem very useful. If you put in the number of days since the first case, you see that the longer this has been going on, the lower the volatility. And you also see that the higher the stringency index, the higher the volatility. Now, stringency is a measure that a group at Oxford has put together, which summarizes whether schools are closed, social distancing is imposed, what part of the country that's on. So they have done a lot of work to try to get this, but it's really sort of an equal weighted index of a lot of things. And it's really hard to know whether it's the right measure or not, but it does seem to come in as a positive explanatory variable here, which means that the more stringent the economy is, the higher the volatility of the stock market. This might be the opposite of what you would expect, but it is conditional on cases. So holding cases fixed, if you have more stringency, you might expect that the stock market volatility would be higher. Okay, so what do we make of this? If this is a stable and structural relationship, which is a big if, and I emphasize how preliminary this is, and there are reasons to be worried about whether this thing really is a stable or structural relationship. Then anyway, policies to stabilize the rate of infection would actually improve the stock market. It would put upward pressure on the level of the stock market and downward pressure on the volatility of it. That's because cases turn out to be the most important explanatory variable. Interestingly, the more stringency there is, the higher the volatility, but it turns out that stringency only goes up when there are a lot of cases. So maybe it's actually just another measure of how severe the crisis is, and therefore has the opposite sign from what you might expect. So what are the conclusions from all this? Well, I think volatility measures are as high as during the Great Depression and higher than the global financial crisis. Pretty shocking. The drawdown has not been as great as either of these so far. Correlations are rising, systemic risk is rising, and the financial impact is found to be correlated with a log of confirmed cases. So really what we said at the very beginning. If public policy can keep the cases down, the stock market may respond in exactly the way we would hope it to. And then once that's done, we can go back to work on the climate change. So 2 of my grandsons worrying about what's in the future, and whether it's pandemics or climate change, we don't know. I can also share with you that as we're getting ready to go today, my son and his wife headed to the hospital to deliver twin boys. So there are going to be 2 more grandsons in this family pretty soon. So thank you.
It's great. Thank you so much, Rob. That was a terrific wealth of information and analysis that you've shown all of us. If I could push you a little bit, Rob, on telling us more on the climate change issue. So clearly, it's something that's been rising on the sort of radar of risks that we are now beginning to put on our dashboards and so on. Now, of course, there is one policy angle, which is, what to do about it. But there's sort of, from a financial investor standpoint, there's also this question of how do you deal with this risk? So I wanted to ask you if you've done some work on thinking about strategies or assets that might help hedge climate change risk. And if so, what have you found so far on this dimension?
Yes, there is a whole lot of interest in investing sustainably, and we have a formulation of this, which I think is potentially what investors have in mind, is that they would like to invest in a portfolio that will do fairly well, maybe better than the market as a whole, if the climate is really deteriorating. And so whenever we have news about the climate getting worse, investors, if they have this point of view, would end up buying some hedges against climate change. And so what should they buy? Well, I think there are lots and lots of private offerings, but you would expect that if there's news that the climate's getting worse, that people would be selling their fossil fuel energy stocks and buying maybe broad-based indices in tech and finance and companies that you think are going to actually do pretty well. And maybe you would buy renewables, but the market is so small in renewables that you can't really do that trade in a very large quantity. But in any case, we've done a lot of work trying to figure out what these kinds of portfolios might look like. And today, some of these portfolios are actually doing extremely well because really not for the main reason you would expect, but they're doing well because the oil price shock means that the whole fossil fuel energy is doing badly. And so if you've shorted that in your portfolio, you're actually have some bright light in the middle of a bad portfolio performance. But as I said before, if we really succeed in bailing them out and making them whole, then that benefit will be gone. It'll be paid for out of the state and our taxpayers.
There's a related observation and a question, Rob, from Jay Freeman. He's referring to the reinvesting in traditional energy right now being referred to as a missed opportunity in some of your early remarks. And he's raising the question as to one thing we have to worry about is whether the renewable smart energy projects are readily available. Do we have staff properly trained in the same amount of time that it would take to, deal with the bankruptcies of some of the traditional energy projects. I wonder if you have any thoughts on Jay Freeman's question.
Well, I think I'm not sure I can give you firsthand information, but the growth in renewables has been very rapid and enormous. There are large wind and solar projects in all stages of development, but I think at this moment, everybody is sort of reeling from the pandemic, and so my anecdotal evidence that I've read about sort of suggests that some of these projects have been slowed down, and investment money has been slowed down by the pandemic. So maybe there are opportunities there, and I just am not sure quite how you capitalize on them.
Thank you, Rob. There's sort of another interesting observation in this line by Philip Wolfers. He's concerned that the lack of capital and poor performance that you've just referred to might in fact slow down the ESG-related initiatives in the corporations further down their priority list. He's referring to short-term survival taking precedence over dealing with the stress test of a global shutdown because, we have some other emerging climate risks down the line. On the one hand, it suggests we might see even further underinvestments in dealing with it. I wonder, on the other hand, whether it means that there is, in fact, a greater role for some sort of incentivization of these sorts of measures. Do you have any view? You referred to a carbon tax in the slide, Rob, so maybe you can tell us a little bit more about this.
Well, I think that one of the things that has slowed down the transition to carbon in the U.S. is the fact that people don't really think the costs of climate change are going to be that great. There are some people that are going to bear a lot of costs who have coastal properties or properties in wildfire areas or something like that. But that's not me. That's somebody else. And so one of the things about this pandemic is if you think of the pandemic as part of the cost of climate change, which I don't know whether that's going to turn out to be scientifically valid, but certainly one of the things people are concerned about is, tropical diseases like malaria and dengue fever and so forth that are borne by mosquitoes. But we haven't talked about things that are borne by bats or pangolins or, any kind of animals that might be unfamiliar to us, but might appear through this climate migration. Anyway, if those kind of zoonotic viruses are going to be more common, then it's pretty easy to say, we want to do whatever we can to avoid having repeated episodes like this. And one of the things to do is just to encourage the transition to renewables, which I think people overestimate how expensive that's going to be. There will be some losers and some winners, but basically, as soon as you change the relative prices, I think all these clever fossil fuel people that have been pouring into fracking businesses will figure out exactly how to get into the wind and solar business and the distribution of it and so forth. So I think that our economy is pretty flexible and willing to invest when it looks like the profits are there.
Thank you, Rob. Let me turn a little bit to some of the volatility metrics that you showed us. How much of the oil price volatility that we've observed, which is sort of extraordinary, I think, right now around 120%, something like that, as per your estimates. How much of this would be consistent with just a gauge model in which oil prices have crashed versus the additional policy uncertainty that we have seen come to the table because of the OPEC lack of agreements and, the constant back and forth as to whether they're likely to engage in cuts or not? Will there be US pressure on them to do so? Is there any way to isolate sort of a more what looks consistent with the crash of oil prices versus an additional wave of uncertainty due to policy uncertainty that's been released into the mix?
Well, I think that what we're seeing is some sort of a tail event. We're seeing things that you would not predict with a Garch model. But if you simulate a Garch model, then you'll get events which are this extreme sometimes, and that's kind of what I was showing with the long run value at risk. And so I think if you were to back out the residuals, what you would see is a bunch of negative residuals in a row, and that by chance is unlikely. But that's what it means to be a tail event. And so I think what we're seeing is that the economics play out by having these negative shocks to the oil business day after day after day, as people observe that both demand is down and supply is up, and negotiations are failing, and the frackers don't want to join the negotiations, and each of these is an event which has a negative shock to the oil industry. So they accumulate into a really high volatility and a big price decline.
Thank you, Rob. Here's an interesting question from Mayor Richard Thomas. And I wonder if it has something to do with the last results you showed us on the link between volatility and the growth in the number of cases. Is there some way in which the models you've shown us can be used to gauge the right time to restart the economy in terms of moving from sort of social distancing and lockdown to opening up?
Well, I would like to think that there is something there. What I'm modeling is not the infection rate, however. It's the result of the infection rate on the financial economy. I mean, I could also build a model on the infection rate because it's the same data. So that's a possibility. But of course, what we need to know is how these policies affect this model. And so it's not really just a time series model. If it's a time series model, then I guess when the curvature is such that you've reached the peak, then I'm a little concerned that doesn't tell you whether you can reduce your social distancing pressure or not. It just says it's working, but it doesn't tell you what would happen if you stop it.
I see. Rob, one uncertainty that is on the minds of a lot of investors, modelers, and the common man is even if we did actually get to a point where we thought the curve was flattening and we relaxed some of the stringency measures, could there be repeat waves of the outbreak? Is there some sense in which we could estimate likelihoods of these using the sorts of models that you just mentioned, which is and fundamentally, would these probabilities have gone up in your models compared to, say, the history until December of last year? Well,
most people think that the that the rebounding of the virus has to do with the amount of the population that's uninfected and how susceptible they are to being infected. So if I thought that by putting population into these models, I'd be able to see when the cases were an appreciable part of the population, you'd see this curvature effect rising. But at least in both the US and China, which are enormous countries, the percentages of uninfected people remain very high. So it's not really that the hope is that we're going to run out of everybody is going to already be infected enough so that they have antibodies and the spread can't really happen. So I don't know whether that's the mechanism that is leading to this curvature that leads to a peak. I think it's more likely that the mechanism is that we've shut down enough business and done enough social distancing that people are not becoming infected at the same rate, but it's not that we're running out of people, if you know what I mean. And so I think that reducing social distancing, I don't see how these models are going to be able to answer that question.
Mm-hmm. Rob, we are close to the finish line, but we have time for two more questions. So I'll tell you both the questions, and maybe you can use 2 to 3 minutes that we've left to get at them. One question is, as a part of this, let's use the term building immunity against economic fallout of these sorts of shocks. Do you see that supply chain management may have to alter in corporations to deal with the fact that maybe we need to build in some resilience? So does it have to move away, for example, in pharma sector in terms of imports from other countries? And the last question, which I have saved till now, is if you were to talk to the president, what would be the one fiscal policy suggestion that you would suggest?
Well, I think people who do worry about supply chains have a lot to think about. I think this really will change the way supply chains are organized. We've moved to shorter and shorter supply chains because the response rate is so quick. And now, if it turns out that it's variable, then I think people are going to have to do some more inventory management. But maybe there are other choices too. I mean, there may be a diversification of the supply chain, which would be an alternative to just more inventories. So I'm not quite sure, and I don't know where the inventories would be, whether they would be in primary production or in finished production, and what's the most efficient way to hold such inventories. I'm not completely sure that the supply chains have broken down. I'm kind of amazed at how good they've been. I mean, although we're running out of toilet paper, I mean, most everything seems to be in the stores, or at least where I am in California. And that's without anybody on the streets. I mean, the only people around are the truck drivers, and they're delivering stuff. And so I am not sure exactly what implications are going to be drawn about changes in supply chains, but I imagine there will be some updating of that. So what would I tell the president? Well, I mean, I think the president should own this crisis, and he should be a commander-in-chief and organize both the social and the economic response. I think we've made a very large economic response, but I think it's primarily come from Congress. I don't think that the White House has done too much on this, and but I'm sorry that the bill does not tilt toward renewables and energy and allowing some fossil fuel firms to fail without support. I think it's kind of interesting to think about the lending program, which requires firms, especially small firms, to maintain their staff in order to have the loan forgiven. I think there's going to be some interesting cost-benefit analysis of that when workers have a choice between switching jobs and moving to becoming an Amazon truck driver or unemployed versus staying as an at-home restaurant employee. I don't know from a social point of view how that actually adds up. I think it's good for getting cash to individuals. And I think maybe that's the main reason for doing it. But there may be social costs that economic costs that come from that.
Thank you so much, Rob, for this terrific set of slides on how financial metrics are panning out since the pandemic has hit the global economy. Thank you also for the stimulating conversations, especially on climate change, how we might have to deal with it going forward, and some of the cost-benefit analysis of the recent programs that have been introduced. Thank you to all the participants as well. I think we can all take a round of applause for Rob, clap or knock on the desks at your respective ends. And just to remind you, we have a few more faculty and forum insights in the coming weeks. Stay tuned. We'll be with you very soon. Thank you, everyone.
Thanks, Viral. Thank everybody.